Hello, good morning, everyone. Welcome to Phillip's Securities Research Morning Call. Today, we will go through stock counter updates. So today, for the US market, we have Salesforce result. Then, and then for the Singapore market, we have Frasers Property Limited, visit of Aaron, and then Manulife US REIT, Phillip on the ground, and LHN, the result, right? And then for the technical analysis, we have for S&P 500, ETF monthly for November. And then we also have macro and sector outlook. We have for quarterly semiconductors for the US market, Singapore weekly, and the Singapore monthly. Please also be informed that two of our analysts, Helena and Serena, who's covering on the US market, are on leave today. And also on the 15 December, which is next week, would be our last weekly Monday webinar session. Then we would have a holiday break, then resume next year in January. So this is our usual disclaimer. Please be mindful that this presentation is solely for education purpose only. So please do reach out to your financial advisor before you make any form of investment. So moving on to the first presentation is Salesforce. So they released their third quarter for 2026 result, and then our title is a guidance rises from the Informatica acquisition. Yeah. So the 9 months, the third quarter revenue and adjusted PATMI were at 74% and 80% of our financial year 26 forecast. So the revenue met our expectation at 74%, but the earnings were ahead of our expectation at 80% of our forecast. And the strong earnings was because of the delay in timing expenses. So they spent less in expenses than what they expected. And then there was also faster collection in the bad debt, right? And then moving on to the positive point, first point is that there's strong demand across all products still. So the group revenue rose about 9% year over year, with the main business segment, which is the subscription and support revenue, which make up about 95% of their revenue, was up 10% year over year. The core offering, which is their sales and services cloud, grew about 8% year over year to $4.4 billion. So while the fast growing segment, which is the collective of platform segment, including Agentforce, their AI platform, Slack, and other offerings that they acquired over the last few years, increased about 19% year over year to $2.2 billion. The 9% year over year growth was driven by the group revenue growth was driven by mainly by the Agentforce, which is their AI platform, and Data 360 and Agentforce sales and service performance. Their AI platform at this moment, I think when it comes to revenue, is still small. But then again, its users, when it comes to AI, right, is spread out across all the other services. And then moving on to the next point is the acceleration in artificial intelligence, their AI. So Agentforce and Data 360, which is their AI platform, which is quite small in terms of revenue, generated about $1.4 billion in annualized recurring revenue. So if you compare that with the group revenue last year, that is about 3.6% of their group revenue. So it's small in comparison. But this AI adoption this quarter was up about 114% year over year. So it's like slightly more than double. So when we see the double growth rate in adoption, it shows that the Salesforce AI is quite promising. And what's more, because over 50% of the new Agentforce and Data 360's booking came from the existing customers expanding their investments. They are buying more seats for this new AI. So we see acceleration in the artificial intelligence for the Salesforce. Next positive point is that better than expected earnings. Adjusted PATMI rose about 33% to $3 billion, while the adjusted earnings per share of $3.25 exceeded guidance of $2.85. So this was, by this quarter alone, was supported by delay in timing for the expenses, also faster collection in bad debt. Also at the same time, the margin expanding about 1.3 percentage point to 21.3%. So the operating margin keep expanding. So that's the play when it comes to Salesforce. Although their sales is accelerating, but they have done a good job in expanding their margin through their efficiencies and cut costs. So this reflect most of the efficiencies come from their biggest sales operating expenses, which is the sales related expenses. About 60% of the total operating costs grew about 4% only year over year in this quarter, while their revenue grew about 9%. So they are enjoying operating leverage right there. So that's for the positive point. There's no negative point. For the outlook, recently they acquired Informatica. This was announced about 4 months ago, but they completed this about in November, just recently. So from this acquisition, they raised their guidance, right? Because some of the Informatica revenue was now accounted into their revenue. So for the full year guidance, which is at least for the next one more quarter until the end year of 26, Salesforce raised its guidance. They expect group revenue to grow about 9% year over year to 41.45 to 41 or 55 billion US dollars. So this is including the 80 basis point contribution from the acquisition. Also, the company reduced its operating margin to 20.3% is the expectation, while increasing its operating cash flow growth to 13.14% year over year. And this was supported by strong bookings in the current quarter. The outlook for the current remaining performance obligations, which is CRPO for short, which is an indicator for the future revenue that they would generate, was raised about to 15% year over year from 11% organic growth if you exclude the Informatica acquisition. So this is also coming from the 500 billion US dollar FX tailwind. So that's for the outlook. Sorry, give me 1 second. Good morning, everyone. Welcome to Phillip Securities Research Morning Call. First of all, we'd like to apologize about 5 minutes late, right? From our usual webinar. Much apologize. So start a bit late. I don't know what we're supposed to, right? Right. So without further ado, let's start our presentation for our morning call. So today we have multiple stock counter updates. We have Salesforce for the US market, the result coming out last week. And then we also have for the Singapore market, we have Frasers Property Limited, visit note. And then we also have Manulife US REIT, Phillip on the ground, and then also LHN results. And then for the technical analysis, we have S&P 500, and then also for the ETF monthly November. And then we also have macro sector outlook. For quarterly, we have Semiconductors. And then for the Singapore weekly, and then Singapore monthly by Paul. All right. So please be informed that 2 of our analysts covering the US market, Helena and Serena, are on leave. So, and also that the 15th December, which is next week, would be our last weekly Monday webinar session. Then we would have a holiday break, then resume again in the next year in January. So now moving on to the next slide is our usual disclaimer. Please be mindful that this presentation is solely for education purpose only. So please do reach out to your financial advisor before you make any form of investment. All right, so this is for the first presentation, which is Salesforce. They released their third quarter 26 result last week, and then the title is Guidance Rises from the Informatica acquisition. So for the 9-month revenue and adjusted PATMI were at 74% and 80% of our financial year 26 forecast. So the revenue met our expectation at 74%, but the earnings were ahead of our expectation at 80% of our earnings. So this time the earnings were stronger was because of the delay in timing expenses. So they spent less in expenses from what they expected, and there's also faster collection in the bad debt. Right. So moving on to the positive point, first is that there's a strong demand across all products. The group revenue rose about 9% year over year, with the main business segment, which is subscription and support revenue, which make up about 95% of their group revenue, was up 10% year over year. The core offering subsegment, which is sales and services cloud, grew about 8% modestly year over year to $4.8 billion US dollar. Right, while the fast-growing segment, which is the collective of platform segment, including Agentforce 360, their AI platform, Slack, which is most of their platforms that they acquired along these years, and other more offerings increased about 19% year over year to $2.2 billion US dollar. The 9% year-over-year growth was driven mainly by Agentforce, their AI products, and Data 360 and Agentforce sales and service performance. So their AI platform is still rather small, but then again, when it comes to AI, most of the companies, what they do is that the AI functions is spread out across all the other segments as well. Although when it comes to revenue generation, they have specific segment to gauge how AI generate money, which is the Agentforce 360, which is rather small. Next is the point is that we see acceleration in artificial intelligence. So Agentforce and Data 360, which is their AI products, generated nearly $1.4 billion US dollar in annualized recurring revenue. If you look at it, it is 3.6% of the last year financial year group revenue. So 3.6% is rather small compared to the group revenue. But the growth rate, which is 114%, which is slightly higher than double year over year in this quarter, shown promising that Salesforce AI product it was received quite well from the customer. And also from this growth rate, over 50% of the new Agentforce and Data 360 bookings came from existing customers. They're spending more to get more of these AI functions. So that highlights strong adoption and acceleration in artificial intelligence. Next is we see better than expected earnings. The adjusted PATMI rose about 33% to $3 billion US dollar. Right. And while you look at it, earning per share term, the adjusted earning per share was 3.25 US dollar and exceeded the guidance of 2.85 US dollar. So for this current quarter, the stronger earning was because of the delay in expense recognitions, and there's also faster collection in bad debt. So also at the same time, the operating margin expanded about 1.3 percentage points to 21.3%. So they have been, when it comes to Salesforce, the story is that although the sales growth rate have been decelerating for the last few quarters, but they have done a really good job when it comes to expanding the operating margins. They focus on efficiencies. For examples, their sales-related expenses, which is their biggest operating expenses, which is about 60% of their total operating costs, grew by only 4%, while their revenue grew about 9%. They are quite fixed on that. So yeah. Next is on the outlook. Recently, they acquired Informatica, right, on November recently, and that have lifted their top line guidance because they're incorporating the revenue coming from Informatica to their group revenue. So for the full year guidance, they raised their group revenue to 9 to 10% year over year group rate to 41.45 billion US dollar. So this would include 80 basis point contribution coming from the acquisition, a little bit higher, right, than what we expected. The company also reduced their operating margin to 20.3% when they would consider the expenses coming from this expenditure in investments. And also, they also increased the operating cash flow growth outlook to 13 to 14% year over year, supported by the strong booking in the current quarter. And then the outlook for current remaining performance obligation, which is an indicator for future revenue that they would generate, was raised to 15% year over year from 11% organic growth if you exclude the Informatica acquisition. There's also $500 million US FX tailwind benefit there. Our view when it comes to Salesforce is that we see that the sales has been decelerating. I think this is not new. This has been going on for the last few years, every 2 to 3 years, and we have seen for the last few quarters. The revenue has decelerated from 15% 3 years ago to 9% year-over-year growth rate because of their customer headcount continued to reduce over the last few months. So we are seeing softer sales from the uncertain macro environment and reduced discretionary IT spending. Like many of the enterprises are budgeting their expenses when it comes to IT equipment and to have their sales and all that. But Salesforce have been doing really well. their profitability, their focus on profitability while their sales is slowing down. Their operating margin has been expanding quite huge from a single digit to 21%, right? In the same period for the last 3 years. So it shows that they are very disciplined in their spending, particularly when it comes to big cost in sales operating expenses. And they make use of the artificial intelligence that they themselves promote internally to have streamline the tasks. For our call view, we maintain buy rating call with a raised target price to $382 from previously 264. Because we raised our revenue forecast by 1%, raised our earnings by 5%, fully forecast. And this is coming from the raised guidance that they said, and then also following the strong third quarter results, right? So we have to raise our forecast. So the currently stock is trading at 22 PE, which is a tad below, a little bit lower than the 1 year historical average of 25 PE times. So we think it's quite a little bit cheaper than average. So we still like Salesforce because of the ongoing margin expansion for the last few quarters. And then there's also robust free cash flows. And because they are less capital intensive compared to the other stars, they're not hyperscalers. Then there's also quite resilient demand for its core offerings growing at 9%, right? I think that's all from me when it comes to Salesforce. Now I hand over to Ben for semiconductor presentation. Thank you.
Thanks, Fahmi. Yeah, I'll be presenting on semiconductor third quarter update. Our report title is Processor and Memory is Poised for Growth Acceleration. Yeah, I'll explain more on this in the next few slides. Yeah, so overall, this is the snapshot of the results of the semiconductor companies that we track. So yeah, so I think previous slide less confusing. Yeah, so for the as you can see in the table, the companies are being split into the four categories. For processor, we have the GPU companies and CPU companies. For memory, we have the companies mainly focusing on high bandwidth chips. For equipment, the companies that are supplying equipment to the foundries. And then, yeah, last but not least, TSMC. Yeah, so we see overall the third quarter revenue increased by 31% year on year, and this is also a sign of growth acceleration from previous quarters, 27% year-on-year increase. And this is being driven by cloud service providers transition to leading edge technology. So for example, NVIDIA's Blackwell GB300 GPUs, and also for AMD's MI350 series GPUs. So you see NVIDIA and AMD, their revenue growth has been quite significant compared to the rest. And also the companies that benefits from this trend is also Micron as well as SK Hynix, because their high bandwidth chips are also being incorporated into the NVIDIA and AMD's GPU itself. Yeah, next slide, please. Yeah, so in terms of overall processor and memories revenue growth itself, it can be seen in the chart at the bottom right hand corner. So the processors revenue is the red color line, whereas memories revenue trend is the orange color line. It has been decelerating for the past consecutive 5 quarters. We do think that it is reaching its trough because hyperscalers has been ramping their capex investments for the past few quarters. For example, since the start of this year, it's been 62%, and in the latest quarter, it is 66%. We do think that going forward, they will still continue to increase their capex investments. Especially can be seen from Google, Meta, as well as Microsoft's capex guidance. They guided that 2026 capex investments will be significantly higher as compared to 2025, because they observe very strong demand from cloud customers, and also they are looking to build up their AI infrastructure. So we do think that processor and memory, they are entering the next phase of growth. We do think that in terms of revenue growth itself, revenue growth deceleration, it is reaching its trough. We do think that it will enter into a higher growth phase from 2026 onwards. Yeah. Next slide, please. Yeah, so zooming into processor itself, we do see higher demand from sovereign countries, especially from the UAE, Saudi Arabia, South Korea, and European Union. So as you can see from the news out there, they have been signing deals to acquire a few hundred thousands of NVIDIA's GPU chips as well as AMD GPU chips to build up their AI clusters. I think there's some news recently about Google's tensor processing units (TPUs), which may pose a threat to NVIDIA's GPU. So yeah, so as you can see in the table at the bottom right hand corner, this is the breakdown of Google's TPU compared to NVIDIA's GPU as well as AMD's GPU itself. So let's take a look at the first column itself. That represents the peak throughput. So the metric that represents performance itself. Uh, do bear in mind that these are just our estimates. So because it depends on third-party providers' data itself, so it may not be applicable throughout all different models. But this is just our average, our estimate for the average peak throughput. So in terms of Google's peak throughput, it is 4,600 teraflops. So it is in between NVIDIA and AMD's performance. In terms of peak throughput, AMD's GPU is still the best performing. In terms of the second column, thermal design power. So basically, that is the amount of heat being dissipated when the chips are running the AI models. So, of course, the lesser heat being dissipated, the better it is because there will be less constraints in terms of the cooling technology needed for the chips itself. So for Google's TPU, it is the best performing out of and compared to NVIDIA and AMD's GPU. So if we divide the first column by the second column, we get the performance per watt. So in terms of efficiency wise, Google's TPU is the best performing out of NVIDIA and AMD's GPU. And in terms of average selling price, that one is also the estimated figures because Google doesn't disclose. I mean, all three companies doesn't disclose the average selling price, but based on our estimates, Google's TPU is the cheapest among the three companies. So I think some of you may ask why is AMD able to sell at a cheaper average selling price compared to NVIDIA's GPU, even though um even though it has a better performance per watt. Why does it have to sell at a cheaper ASP? So the answer to this is because of NVIDIA's CUDA software ecosystem. Because right now it is the market standard for GPU software developers. A lot of them when they are in university studying for AI coding, they are using CUDA software to learn. So there's a lot of developer tools. I mean developer tools inside. There's a lot of support within the ecosystem for the software developers to use. So it's easily portable throughout the different functions. And so because of this NVIDIA's CUDA software, they are able to command a much higher average selling price as compared to Google's TPU or AMD's GPU itself, even though it is slightly worse performing in terms of performance per watt. And also just to emphasize for Google's TPU itself, it is application specific chip. So it's an ASIC. So basically what it means is um, this TPU is only designed for a particular purpose. For example, inference. So for example, um, if a hyperscaler wants to use the chip to train AI data in order to come up with an AI model, they cannot do so because Google's TPU is only designed for inference. It is not designed for training. Yeah, so um, that that is also another reason why NVIDIA's GPU can command a higher average selling price as compared to Google's TPU. Yeah, so I think it I think Google's TPU will present a kind of risk for NVIDIA's margins to compress because it may pressure NVIDIA to lower its average selling price. But we do think that going forward, NVIDIA is still able to protect its GPU market share because of its CUDA ecosystem software mode. Yeah. Yeah, so evidently, even though AMD released their GPU, which has a better performance as well as a lower selling price, they are still unable to take market share from NVIDIA over the past few quarters. So we do think that going forward, this will still be the case. Yeah. Um, yeah, so talking about another soft processor company, Broadcom, we do think that their fourth quarter revenue will be able to beat their guidance because they are designing the ASIC chip for Google itself. And we do think that their revenue will continue to be strongly driven by the demand for the custom AI accelerators from its three main customers, mainly Google, Meta, as well as ByteDance. In terms of memory-wise, uh, we see a trend where demand outpaces supply. So the memory revenue increased by 27% year on year, which is the highest increase since fourth quarter last year. And all three companies are indicating that existing resources are being allocated to ramp their high bandwidth memory supply. So uh, there's supply constraints in the DRAM and NAND segments. So we do see some price increase in these segments itself. And Micron and SK Hynix guided capex to be higher, and we do think that this will benefit Lam Research. Yeah, so I'll explain more in the next slide. Yeah, next slide, please. Yeah, so yes, if you can look at the chart at the bottom right-hand corner first, this is the chart of memories capex, which is the blue color line, compared to Lam Research revenue itself. So as you can see, there's a very strong correlation between memories capex as compared to Lam Research revenue, because it makes up about 35% of Lam Research revenue itself. Memory chips make up 35% of Lam Research revenue. Yeah, so we do think that the increasing capex guidance by the memory companies will be able to benefit Lam Research. Yeah, so talking about the overall equipment sector, we do see some growth deceleration, and this is because mainly caused by TSMC's order delays. We see TSMC's capex growth slowing to 49% year on year in the in the most recent quarter, as compared to 113% year on year peak in last year fourth quarter. And however, there's some light at the end of the tunnel, because all three equipment companies expects growth to be weighted towards the second half of next year itself, because they see an acceleration of wafer fab equipment spending at that point in time. I do believe that this is because through their conversations and deals being signed with their memory customers as well as their foundry customer, they are able to provide this kind of guidance, and it's consistent among all three equipment companies. Yeah, so in terms of foundry wise, we do expect volume production of 2 nanometer chips to drive TSMC's revenue growth for the next quarter. For the full year capex guidance itself, they increased the guidance by very slightly by 3% to 41 billion, compared to their previous guidance it was 40 billion. So this increase in capex is lower than our expectations, and we think that the slowdown in equipment's revenue growth will still continue as a result. TSMC also hinted at a higher capex next year, but they also mentioned that capex is unlikely to suddenly grow significantly in any given year. So we do think that capex growth will be moderate, and we think that this capex growth will be more weighted towards the second half of next year itself. Also consistent with what equipment companies are saying. Yeah, so next slide, please. Yeah, so this is the overview of the valuation snapshots of the companies. In terms of processor companies, we think Nvidia is attractive because they are currently trading at a slight discount, 38 times forward PE as compared to the average 45 times forward PE among processor companies. And they also have a very strong revenue visibility of about $380 billion for the next 6 quarters. So we estimate that to be about 67% year-on-year increase. Because currently their Blackwell GPU is still ramping, and they also have the next generation Vera Rubin GPU upcoming at the second half of next year itself. As for Micron, we think it's attractive also. Currently their PE is trading at a 13 times forward PE as compared to the average memories PE of 14 times. And we think it's attractive because currently their high bandwidth chips is being designed into AMD's GPU as well as Nvidia's GPU itself. So there's a lot of growth visibility going forward, and they also have a lot of manufacturing capacity within the US itself. So we think that they are able to receive more support from the US government, especially with the US President's Donald Trump's push to increase manufacturing within US soil itself. So we think Micron will stand to benefit from that. In terms of equipment, we think Lam Research is attractive because even though Lam Research has the highest growth among the equipment companies, its PE is still very reasonable. Currently, the forward PE is 33 times as compared to its peers, 35 times. Yeah, so we think that Lam Research is attractive as well. Yeah, so that's all from my end. I'll hand over the time to uh, Darren, I think. Thanks.
Yeah, thanks, Iqbal. Yeah, our Frasers Property Limited's site visit note. So we titled it value waiting to be recognized. Yeah, so we think there is some value in the share, but the thing that's holding it back currently is its trading volume. This trading volume really is very, very weak or very low. Yeah, so for company background on FPL, yeah, the market cap is 4.3 billion. It's an investor and operator and owner also of real estate products and services across the property value chain. Yeah, so it operates in commercial, business parks, hospitality, industrial and logistics, residential and retail. So its presence is all over the world, so Southeast Asia, Australia, Europe, and China. Yeah, so currently, after the privatization of FHT, they are the sponsor of two SGX listed REITs, FCT and FLCT. And the group they also have two listed REITs on Stock Exchange of Thailand. Yeah, so for the earnings drivers for FPL, we think going forward will be continuing they will continue to build its development pipeline. So currently they secured the Dunning Road GLS site. So that will help with its pipeline of developed projects and also achieving strong sell-through rates for its projects. Yeah, and also the continued ramp up of One Bangkok. So One Bangkok is a 2 billion GFA, 2 billion square meter GFA of land development. So that is a huge mixed use development, and they're also trying to lower their gearing. So currently their gearing is about 89% as of the late 30th of September. So they're trying to lower it by unlocking value and divesting assets. So potentially recycling these assets into some of the listed REITs like FCT, FLCT, or to third parties as well. So in FY 2025, they divested 1.4 billion. So that's similar to about FY 2024, also about 1.4 billion. So FY 2025, about 45% of this was divested into its listed REITs. Yeah, and also for them, they're also looking to strengthen their recurring income and fee income. Yeah, so currently FPL trades at a big discount to the book value, 57% discount. And it pays 4.5 cents in dividends in FY 2025. So that translates to about 4.4% dividend yield. Yeah, but then again, we think the reason why its share price has not run as much as the other property companies is some its trading volume is very weak. So I think that holds back a lot of institution investors as well from investing in FPL. Yeah, so let's move on to some of our site visit pictures and updates. So first of all, we visited Araya. Yeah, correct. Next slide, please. We visited Araya. So Araya is a fully integrated industrial tech ecosystem, and it's also a smart industrial city in Thailand. So it's very, very well located. It's just like 20 minutes from the airport and 40 minutes from Bangkok Port. And it's also like less than 30 minutes drive away from civilization, meaning a huge mall, Mega Bangna. Yeah, just 30 minutes away from that. So it's in for industrial land, it's very, very well located. Yeah, and basically this project Araya is a JV between three parties. So FPL, they own 50% and they are the lead developer. Yeah, so this whole project is about 4,600 rai or about 740 hectares. So about 1,800 of it is designed for industrial land sales. So currently out of this 1,008, about 600 has been already sold. So this is a very new project, only less than 1 year. So the remaining of the space, like 4,600, 1,008 will be used for other users like industrial users and some possible amenities and lifestyle as well. So that has not really been decided yet, and also possibly residential. Yeah, so for the industrial land sales, 600 rai is really sold, like I mentioned, and out of these 600, 125 right is taken up by Infineon. So you can see the picture in the middle. So that is their building is really up. So they build it up real quick. Like less than 1 year, it's really the whole building is up. And yeah, Mr. DIY is also a major buyer of land. So they bought 158 right. Yeah, so you take a look at the infrastructure that FPL has built up. So that's in figure 1. So there's a 6-lane spine road. So that will help with the traffic and transportation of goods. And yeah, basically the third slide just shows the welcome and description of the property. Yeah, so this is the Araya, the Eastern Gateway. Next slide, please. Yeah, we also visited Good Sukhumvit 76. So this Good Sukhumvit 76 is a low-rise, high-end residential development by FP Frasers Property Thailand. So if you don't know, in Thailand, they are facing some the residential market is facing some severe downturn. So this is due to high household debt. Like in Thailand, when they buy property, sometimes they can even borrow over 100% LTV. Yeah, so as a result, a lot of these so-called low to middle income home buyers, some of them they default on the payments, and as a result, it's like they affect the whole property market. And so right now, let's say for the mass market, if you want to take a loan, the rejection rates can be up to 60%. So it's not easy to take up a housing loan. So as a result of this so-called this residential market downturn, because of this high household debt and defaults, FPL they're shifting towards the higher end, more resilient upper tier market where it's easier for those with good jobs like high income earners to secure loans and such, or even those who do not need to borrow to buy houses. So that's why they're shifting towards a higher tier. Yeah, so as a result, they built this Good Sukhumvit 76. So this is very high end. You can take a look at the pictures. So they have 118 units of 2-story detached houses and 3-story semi-detached houses. So the starting price is about 15 million Thai baht, all the way up to 30 over million Thai baht. Yeah, so it offers about 3 to 4 bedrooms depending on which one you get, and 4 to 5 bathrooms as well. And also all the properties has space for more than three cars. Yeah, and yeah. So we take a look at the picture. So that the one on the left is the Lara, is the second largest detached house. So it's huge, 355 square meters, 2 stories. And the Zenith is the largest one. So that's in figure 5 and figure 6. So that is the master bedroom. So they have a couple of master bedrooms. So you see the middle picture is one, and the one on the right is another one. So that's in the same house. Next slide, please. Yeah, so the finishing is also very high end. Like you see that the chandeliers at Zenith, that is the one on the left, and they do have some amenities like they have a playground, swimming pool, clubhouse, fitness center. Yeah, so the picture in the center is a play area for pets, like it's a pet society dish. And figure 9 shows figure 9 just realized the heading is wrong. That is actually the very luxurious bathroom and there's the play area. So yeah, the bathroom is huge, super luxurious. You can put a yoga mat there and do yoga in the toilet as well. Yeah, there's a lot of space there for that. So it's very luxurious. Next slide, please. Yeah, and the one on the picture on the left shows the clubhouse. So it's a 2-story clubhouse at Sukhumvit, a Good Sukhumvit 76. Yeah, so those are all the pictures I have for the Good Sukhumvit 76. So the next one that we visited was One Bangkok. So just a recap, One Bangkok is a huge development, about 5 billion Singapore dollars mixed-use development with a GFA of about 2 billion, like I mentioned, 2 billion square meters. So the whole project is mixed use. So it comprises 5 Grade A office towers, 3 luxury hotels, service residence, service apartment towers as well, and residential towers and retail precincts as well. Yeah, so it opened last year in phases, starting last year. So it will continue to open progressively over the next couple of years as well. So within One Bangkok, we visited the Ritz-Carlton. 189 Wireless, which is residential, a fully sold residential, and the collective, which is a co-working space in one of the office towers. Yeah, so the picture in the center, it shows the view from the Ritz-Carlton lobby. So Ritz-Carlton, they occupy the first 25 floors in a 50-story building. The next 50, the 25, the 25th floor, 26th floor to the 50th floor is occupied by 189 Wireless, which is the residential that I mentioned. Yeah, so the picture on the right is the bathroom of the Ritz-Carlton. Next slide, please. And yeah, so the left-hand side is the view of the basically the balcony at the Ritz-Carlton, one of the deluxe rooms. And the middle picture is the 189 Wireless, which I talked about, the residential project, or that's fully sold. It's a 60-year leasehold. Yeah, so that one fully sold, but obviously because it's fully sold, we couldn't go in to see the houses, so you need to see the common areas. So that's the infinity pool. Yeah, so this whole 189 Wireless, it has 90 units, and yeah, it's the cost, or rather the price of a 2-bedroom is around 60 million baht. So that's about 2.4 million Singapore dollars. Yeah, so that's fully sold, and that is phase 1, and they still have phase 2 upcoming that has yet to be launched. Yeah, and the last picture here is the collective, which is at One Bangkok. So it's a common area it's a co-working space. That's on the 28th floor of Tower 4. So this is the picture here is basically the common area or the lounge area. And membership fees start from about 9,000 baht per month for a hot desk, all the way to about 15K baht per month for a fixed desk. And if you want to be in a so-called executive suite, it's about 300K for 15 desks. So that's roughly 15K per month as well. Yeah, so this is the site visit update that I have. Next slide, please. I'll talk about Manulife US REIT's Phillip on the ground. So this I'll talk about their growth and value up plan to recover from the current predicament that they are in, that their gearing is still breached. They're still trying to resolve the MRA. Yeah, so Manulife US REIT, they came out last week and mentioned that they plan to broaden their investment mandate to invest in other asset classes as well as in Canada. So that is to include industrial, living sector, and retail assets in the US and Canada. Yeah, so they're still also currently basically their MRA is it expires so-called at end of the year. The disposition or divestment target that they originally had was 328 million. So right now they hit about 270. So they have a shortfall about 55 million that they need to divest until the end of the year. I mean, which is unlikely that it's already almost middle of December, so it's unlikely that they'll hit that target. So as a result, this EGM, or rather this resolution, will help to extend the deadline by another 6 months to 30th June to so-called meet this minimum sales target shortfall. And yeah, in this resolution, they're seeking to hit 2 mandates. They're seeking 2 mandates rather. So there's a disposition mandate as well as the acquisition mandate. Yeah, so for the disposition mandate, they are seeking to dispose of up to 3 existing properties. So that is on the tranche 1. And the disposition will not be at a price that is lower than 90% of the latest independent valuation. And for the acquisition mandate, basically you authorize acquisitions in investments in industrial, living sector, and retail assets. And the price that they acquire these assets will not be above 110%. And as well as the fact that when they acquire, they need to hit some they need to meet some requirements as well, such as after they acquire, the gearing must decrease from the current 56%. And so basically when they acquire, they need to use more equity than debt. and the ICR also must not be more than 1.6, and so on and so forth. Yeah, so basically, after when they acquire, the goal is to keep lowering the gearing. Yeah, so they're seeking to hit these two. And if why they're looking at this industrial living sector and retail assets, a couple of reasons. So of US office, for some of the states that they're in, like LA, the recovery is very slow and possibly not in the near term. So they're just seeking to possibly just exit those allocations completely, or the states completely. And as well as the fact that capex is extremely high for US office. So compared to industrial sector, where the capex are much lower, or the tenant incentives, and it's also much lower volatility, and coupled with structured tailwinds like e-commerce growth, nearshoring, and evolving supply chains. Yeah, then the other sectors, okay, as the living sector. So the living sector is also, this according to them, is not as high risk as every year the lease renewal is on a yearly basis. So every year they can increase their rent and be mark to market, and it's also considered hedge against inflation. So because there are many tenants in it, so there's also minimal impact from single tenant vacancies. And other than that, retail, so which is considered the most resilient across market cycles, especially those that are anchored by grocery tenants like Walmart and such. Yeah. Next slide, please. Yeah. So they are seeking these two resolutions, and it's interconditional. So we have to both resolutions must pass both the disposition mandate and the acquisition mandate. Yeah, and sorry. Yeah. Yeah. So if these two resolutions pass, then the manager can start executing this growth and value up plan. So the date to look out for the AGM is 16 December. Just think that's a typo there. 16 December 2025, not 2023. Yeah. Okay, that's all for me. I have no time now to sing for the technicals. Thanks.
Thanks, Darren. Good morning, everyone. So I'll move on to the technicals. Next slide, please. So first out, looking at the chart of S&P 500 last week, it continued the current rebound. So since the candle on two Tuesdays ago, where it recovered back above some of the short-term moving averages, like the 5, 10, and 20-day, as well as the green line, the more medium-term 50 SMA level, the price action has continued to remain strong, where price has been holding above the short-term 5-day moving average, which is the blue moving average you see in the chart. So last week was a bit sideways. I think this week we could still see some of a further sideways consolidation ahead, as it's currently near the previous around the swing high level close to 6,900. So I think this week wise we could still continue to see some sideways movement with resistance generally at 6,870 to 6,950 area, and support is likely to be at 6,750 to 6,815 area, which is currently where the around the 50 moving average is, as well as the swing lows from last week. Yeah. Next slide. Next one, we go through our ETF money for November. So we view that gold is likely to outperform the other asset classes in this month. So first up, to review the performance of the different asset classes in November. Most of them ended up in the green with a rally at the last week of November. So some of the notable gainers were gold, which was up 5.3%, as oil, which was up 5.6%. And then for the losers, the notable one was Bitcoin, which plunged like 17%. And for Hang Seng Index, there was a small loss of 0.3%. So in terms of the current trends, most of these asset classes are still in an uptrend, with the likes of the S&P 500, US Treasury bonds, gold, as well as Singapore equities. And we feel that oil as well as Hang Seng Index are in range consolidation currently. And as for Bitcoin, it's the outlier, as it's currently in a downtrend for now. In our outlook for December, we think that some of the performance of these asset classes could be a bit more muted, with possible some slight pullbacks from the S&P 500, US Treasury bonds, Bitcoin, as well as Hang Seng Index. For oil and Singapore equities, we expect some sideways consolidation after their gains in November. And we think that our performance could be in gold as it could extend its gains in December. Next slide. So I'll go through more in detail the charts of the respective asset classes. So first up, for the VOO, which tracks the S&P 500 ETF. So in terms of the chart, in November, we saw a breakdown of this uptrend channel in blue that it was trading in since May, which previously was steadily trending in. Then there was a breakdown and retest at the end of November. So currently, I think there could be some resistance if it holds the breakdown at around this 630 area for now. So there could be some slight pullback to move into a bit more sideways trading between like 600 to 630 for the VOO. Yeah, if it holds a resistance at 630. Next slide. Next one for the Treasury Bond ETF IEF. So generally, it's still holding in an uptrend. Generally trading in this rising wedge formation since the breakout of this, as well as still holding about the $95 resistance breakout level. In the near term wise, it's more likely trading in the sideways in a tight range between like $96 to $97. So with it closing at the highs in end November, we could expect some slight pullback, but generally still maintain the general uptrend this month. Yes, to continue just a bit of a sideways consolidation. Next slide. And as for gold, generally it's still seeing strong momentum. So overall, it's been a bit of a consolidation since the peak formed in October this year. But price has been still forming higher lows along an upward support line. And generally, I think we could still see gold to continue a bit of a rebound upwards to possibly retest the swing high level form close to about $87 this year. Next slide. Next one for the oil and gas ETF, XOP, generally is still rather sideways, which has been the case since June this year, generally trading between like $122 to about $135. So we think that this range could still continue for now. And thus we expect some sideways consolidation to continue this month. Yeah, next slide. Then for the Bitcoin strategy ETF, BITO. So for Bitcoin, there's been a few notable breakdowns in November where it broke down the range consolidation between like $16 to $18.40. That's the first breakdown. And secondly, there was also a break below this more crucial medium to long term upward support line, which traded above since September 2023. So generally, I think the price action should be still quite weak, and we could still expect possibly a continuation of the downtrend to retest the next key swing low, which is around like close to $12, which was a swing low form in March to April this year. Yeah. Next slide. Next one about Singapore equities, the stock code ES3. So for this Singapore equities, we can still see that the chart is still in a very nice uptrend. Since it's still holding within this uptrend channel that was formed in July this year. So we expect that to continue, but possibly a bit more sideways for this month, as last month actually retested the uptrend channel resistance close to about 470. So we could expect some sideways movement for now. Next slide. And last but not least, for the Hang Seng China ETF. So for this, is currently a bit more it has been a bit sideways since September. We're generally trading about $90 to about 98 for now. So we could potentially expect some continued sideways with potentially a bit slightly some downside if it does retest the uptrend channel support close to about $89 to $90, which is also confirmed with the previous horizontal breakout level in July this year. So I think that will hold as a support for this ETF if we retest the support. So that's all from me. I'll hand over time to Glenn, who will cover LHN results on behalf of Paul, who is away. Thanks.
Okay, thanks, Zain. Yeah, so just to highlight that Paul is actually at a meeting right now, so he won't be joining this Monday webinar. But I'll just try my best to cover him. Any questions, I would please ask you to redirect it to Paul because I don't think I'll be able to answer. We will try to put it up. You can put it up in the P3 community page and you will be sure to get to it. So anyway, let's just begin with the LHN second half results. So in terms of the results, the second half was above expectations. If you look at the full year, it came in at around 109% of our estimates, and the growth was really driven by the co-living earnings. So you look at the positive here, the first red bar there on the left, you can see that for the co-living earnings were actually up around 68%, 67 or 68%. But revenue was down because there was a one-off. So if you exclude that, there was about net about 13% growth. And if you look at the negative, it was really the slower sales of the food factory. So that falls under the property development in the second box here, right? And the earnings was actually a negative 1 million, 1.04 million. So what they did was that they have launched these food factory units, and they were going to sell strata units, but that didn't really, the take-up was quite bad. So that's why they had a loss in the second half, mainly because of the higher interest expense. And but we still maintain the buy because of the listing of Hollywood. We are changing our methodology from a pure PE ratio to sum of parts. So we are since Hollywood is really listed, we are doing a mark-to-market basis with some discount, and then the property development and so on and so forth. So our target price actually lowered to 85 cents, and we thought with the listing, we thought that the market would kind of re-rate the whole sector, but that's why we had a 13 times PE. But I think you can see from the Hollywood share price, it didn't really re-rate as much as we expected. So that's why we're using this, and then it dropped back down to 85 cents. So what you get from LHN compared to Hollywood is that you get a higher dividend yield. The yield now is almost 6%. And there are also going to be more new sources of growth. They're looking at storage space and also the work plus store concept. And also to point out that they are also trading below book. They are trading an adjusted price to book ratio of 0.9 times. So the next slide, we'll move on to Hollywood. Just some next slide, please. Yeah, so for Hollywood, we won't run through everything, but the key message is that there's going to be a huge pipeline. They have around 2,000 more rooms, 714 which are under renovation, and another 1,000 plus land. So this will give them a pipeline. And if everything is cemented, this will sort of translate to a 75% growth. And they're looking at around 800 rooms per year to add. So for Hollywood, there's a lot of growth, and we're looking at the growth for at least another next 2 to 3 years. So for storage, there's around 7, and they're going to add more. And then facilities management is the area where they are planning to grow. So this is basically the cleaning, pest control car park, and they're going to make some acquisitions in this space, which will help to grow the business and make it now that the balance sheet is much stronger. So now that's all for LHN. Now let's move on to the macro data in the next slide. Yeah. So macro data, there's quite a bit of data coming from Singapore, mostly all positive for consumption. There's a pickup in RevPAR mainly because of F1. So we saw a big rebound, and this RevPAR basically is room rates adjusted for occupancy. Arrivals have also improved. We believe that this is all F1 related. Manufacturing activity, the PMI has picked up, and most of the indicators out there that we are seeing is all quite positive. As for US, we also have some data, but we'll use some charts to describe it later. Yeah. So next slide, we're looking at for the tactical views. All the eyes will be on the 10th December meeting, which is the next FOMC meeting. And it's really quite baked in that they're pricing in 95% probability of at least a 25 basis points rate cut. And because the reason why this is so is because of the 2 data points last week for payrolls. The ADP payrolls contracted, and is on a 3-month basis. Actually, it's the first contraction that we have seen in jobs that we have seen since the pandemic. This is because it's quite volatile. The ADP is quite volatile month to month, but if you do a 3 months, it's actually quite a negative number. And the inflation was also quite benign. It was 2.8, which is below the expectations. And with the rate cut, the positive is that it could push the S&P 500 to an all-time high. And currently it's also quite it's just below the, I think Zane went through a bit earlier. It's just below the all-time high. It's about 0.3% below its all-time high of 6890. So I think the all-time high is 6894. Yeah. So in terms of the 2026 interest rates direction, we believe that the market is only looking at 2 rate cuts. The market is not really convinced, even though the Fed chair is expected to more or less expected to change next year. And if you look at the 12 voters, we have a chart later on to show the voters for that decide the Fed rate, the Fed rates basically. But Trump only has influence over the 4, so it's not really he has significant influence, but it's not a done deal that he can get all the rate cuts that he wants to. So he doesn't really have absolute power over the Fed, and we believe that this is a positive because otherwise the bond markets will go out of whack. Yeah. So so we have some events coming up. 8 December we have the SG FX reserves, and 9 December the US job openings number, and then 10 December of course is the all important date that I said earlier. And 11 December we have Broadcom and Costco. And then for our corporate insights webinar, we have 2 that are coming up. The last 2 I guess for this year, which will be Reha on 10 December and Marco Polo on 11 December. So it's free to join. Please sign up with the link below. Yeah. Okay, so next slide, we have some charts. Yeah, so most of the I said earlier, right, most of the indicators in Singapore continue to show that it's firming up. If you look at the thing coming up, you can see that construction is actually starting to bounce back. Yeah. And we believe that the F1 was also the main contributor to the rebound in the RevPAR. Yeah, moving on to the next slide, we're looking at some of the US numbers. Yeah, so the ADP, if you add the ADP line into this payroll data, you can see that the green line, which is the ADP, is actually contracting. So it doesn't really move in line with the private sector, which is the blue line. But directionally, you can see that it does have some sort of relation. So the private payrolls contracting will still be contracting even when we go into the next few months. And the inflation as well, if you look at this red line here, which shows the core PCE inflation, is still kind of stable, even as we forecast it into 2026. We extrapolate the numbers out, and it's also below more importantly, it's below the Fed expectations of 3.1. So it's still below their expectation at this current point. Yeah, moving on to the next slide, we'll be looking at the, just for some reference, the 12 voting Fed officials. And you look in blue here, it's all the ones that are sort of Donald Trump sort of has elected, right? So one is quite dovish, and then the rest is all Biden's voters. So most of the upcoming Fed presidents are considered more hawkish, and Trump's influence is not confirmed that he's got a very strong influence over the Fed. But we think that he's going to put a lot of pressure on them, and that's why interest rates is really one of his only ways to stimulate growth next year. Yes, so moving on to the next slide, we'll also be looking at the Singapore Monthly, which was released I think last week. Yeah, just a quick review of this. So Singapore registered a 2.2% gain in November, and this is the second consecutive month of increase. Year to date, we are looking at so November is almost year end already, right? It's up 19.5%. And the main sector winners were the telecoms conglomerates, really from the healthy results as well as the asset monetization. But we still saw some weakness in the REITs and transport. More importantly, and I guess notably, is that the MAS announced another 2.85 billion of the EQDP funds to be allocated, but the next 50 was actually unchanged for the month. So as for the outlook, we are entering fourth quarter with quite a vibrant economic data in Singapore. Manufacturing has surprised. October industrial production was up 29%. new home sales will also surge by 224%. Banking activities were quite stable, right? We saw quite resilient loans growth of 6.5%, which is actually very healthy if you think of it, because it's more than double of last year's loans growth of 2.7%. And more importantly, the deposits are also quite sustainable. They are sustaining this healthy loans growth and the bank's net interest income. So we saw deposits rising by 8%. And if you look at over the past 12 months, right, the bank deposits have actually doubled to 154 from 70 billion. So this is helping to offset some of that decline in the interest rates. We also believe that tourism could also pick up, with this F1 season, and also the China-Japan sort of conflict that they're having, right? And then we believe that some of this will shift to some of these Chinese tourists will shift to Singapore if they're not going to Japan. And last but not least, the consumer spending is also picking up from the SG60 vouchers, which I think most of us have received. Yeah. So that's all for, I think that's all the slides we have, and yeah, let's move on to the Q&A. Yeah. I think since I'm here, I might as well just take on some of the Q&A first. Yeah, just to highlight again that Paul is at another meeting, so some of the questions will be a bit hard for me to explain because I don't cover the stock. I'm just helping him to present. Yeah. I'll just take on those that are for me first. Let me just look through the questions. Yeah, someone here asked, does the commitment of an increase of 6 pence per quarter in the quarterly dividend payout of DBS from fourth quarter 2025 still stand? Yes. So good question. So fourth quarter, you'll be getting another 6 cents increase, and this will actually last for 4 quarters. So it'll be fourth quarter 2025, first quarter 2026, second quarter 2026, third quarter 2026. Fourth quarter 2026, we're still not very sure yet, but they have committed to 1 more year of this step up. This ordinary step up. So this is not part of the capital returns that they are giving back. Yeah, this is extra. So looking at that, this year we are looking at around $3.06 of dividend. Yeah, for the full year. Okay, yeah, I think I got a few banking questions and some Tesla ones also I saw earlier. Yeah, has your views on Tesla improved after news that Trump is considering an executive order to accelerate robotics development? So yeah, and another one, a follow-up question is, how does Tesla's robots compare to some competitors such as XPeng and Ubitech? Yeah, so the robotics part of Tesla is still such a small, it's really a pipe dream of Elon Musk, right? It is in development. That's why they say, accelerate the robotic development, right? It's not even production. They are still developing it. And if you look at the current pipeline of robots that they have released, right? The first prototype, sorry, right? You can see that the robots are basically they don't really do much, right? Sometimes they follow you around, they fall down, right? I would say to answer the comparison questions with the other, similar robots out there, I think they're all quite similar. They're all pretty bad in the sense where they don't do what they are meant to do, yet they either lag very badly. So you ask them a question, I think there's this video I watched where you ask them a simple question, can you bring me to the pantry? And the robot was just like, didn't understand at all what's going on. And it took maybe 1 minute or so before the robot moved to try to move them to the pantry, right? So these are things that they're not fully fleshed out yet. So it's still very early stage, right? For all the companies, not just for Tesla. That's why I believe that, the view on Tesla my view on Tesla has not improved because they are still a car company. You look at what they're selling is like most 80% is cars, right? And then of course they have their energy storage and all the other things. Robotics is not even part of their revenue stream yet, right? So you're looking at very long term, yeah, not in the near future. Definitely not something that will change, in like the next, I would say even 5 years. Yeah. So I don't think the view has improved because their car sales is still down. They haven't done anything to improve that. And also, yeah, their competitors are just as, poor. All across the board is just all quite bad. The robots are not I guess they have to rush something out, right, to show the investors that they are actually doing something. Yeah, so good question here. Why has OCBC been making new highs compared to DBS and UOB? Yeah, I think the main thing with OCBC is that there's a lot of upside, right? I think the first point, sorry, before I go to the upside part, the first point is that OCBC's wealth management fee income growth was actually a lot stronger than DBS. So DBS is the next, I guess UOB, is their wealth is quite bad, and then they also have that provision and everything, so it's pretty poor. But OCBC's wealth management growth is pretty strong, right, compared to DBS. And also the main difference is that DBS has laid their cards out already to everybody, right? They're telling them this is how much I have, this is how much I'm going to give back to you. You like it, then please buy my share. If you don't like it, then you can go somewhere else. So that's the DBS. But with your OCBC, is like they haven't even opened their cards yet to show what they have. They're just keeping it there, but telling people, hey, I have very good cards. But I don't know whether this analogy is correct, but yeah, it's like saying, hey, I got a lot of money, but I don't know what I'm going to do with it yet. So that's the case with OCBC, where they have a huge amount of capital and they haven't announced any like shareholder returning it back to shareholders yet. Yeah, so it's really the opposite of what DBS is doing, and I guess a lot of investors are now hoping that there will be some upside because with dividend payouts, with dividend yield, hopefully with the extension of the capital returns, because with the news we couldn't expect the old CEO, right, to say anything, Helen, when she was there, because that was the last thing, and then now she's left. So the new CEO has stepped in. We believe that in the next quarter's earnings, which will be sometime in February, right, I think right before Chinese New Year, hopefully they will release some good news, for investors, where they will say that we will give you extend the capital returns, or even or the best news is that they've actually increased their dividend payout ratio, which is still stuck at 50%. Yeah, so that's the reason why OCBC has been making new highs compared to the other two. Yeah, one more here. Will the expected reduction in bought lot size to 10 shares per lot from January, February next year benefit DBS and UOB? What other issuers will benefit from this reduction? Yeah, I think in general, I believe the banks won't benefit as much because I think majority of the people, the majority is from institutional investors, and a lot of the investors, the retail investors who buy also, they buy, they are okay with buying with the normal bought lot size, right? So this 10 shares per lot won't make much of a difference for the large cap stocks. Where we see it making a difference, and which will actually benefit most will be usually the small and mid cap, right? And I think this is in line with what they're doing with the QDP, with the next 50. This is to really drum up a lot of more liquidity and interest in the small to mid caps. Yeah, Serena is also on leave, so that's a Xing one. She won't be able to answer. For Skylink wise, yeah, I gave a presentation last week, I think, Phillip on the ground, but let's just do some quick recap on Skylink. I think Skylink you're talking about. Hold on, give me a minute. Yeah, Skylink is the vehicle leasing company, correct? Yeah, so I did a presentation of it on it last week. So they basically have three revenue streams, and we believe that the growth will be coming from one of the revenue streams, which is their engineering one, and they call it the MRO, where they do maintenance, repair, and overhaul for the vehicles, because they currently have two. They just landed two big new tenders, right? One is from a major bus company, right? So if this holds true, and they do it successfully, then we see a lot of their growth actually coming from this. And also, recently they just announced that they made, I think, a small, medium-sized acquisition. Yeah, so that's their plan currently, to grow their vehicle leasing business, is to do it through via acquisitions, take over consolidation with all the other small players, and that's how they will be growing. Yeah, so this is the way that they'll be growing, and we believe that the growth will come from these two drivers. Yeah, okay. Sorry, give me a minute. Yeah, one here from Ian. Do you think Fed rate cut for December is done deal? Yeah, I mean, we mentioned earlier, what we think the possibility is, and what would the impact be on Singapore bank future earnings? Knee-jerk pullback, then resume uptrend? Yeah, good question. We believe the Singapore bank earnings, like we have shown, right, the deposits growth has rocketed in this year. Loans growth is also going very well, more than double. In I think year to date, November, yeah, it has been very positive. So all these are things that will help to offset the decline in interest rates. And if you look at the Singapore interest rates already, it has technically, been cut by almost, I think it was eight times, right? If you look at it, it has been cut a lot because of the inflow of capital that we are getting. So we believe that the Fed rate cuts, it won't affect it as much as it did, maybe 1 or 2 years ago, where you look at the Singapore interest rates, it really follows quite in line and it's quite related to the Fed rates. So we believe that there will be some transition, but not as much as it was maybe 2 years ago or 1 or 2 years ago. Yeah, so the Singapore bank's earnings will still continue to go strong, really from the loans growth, the strong deposit flow, and also the last one would be their fee income, right? Which have seen DBS and OCBC actually having very good fee income, which is to be expected with lower interest rate environment. And yeah, so I don't think there will be much pullback, right? There will be some, I guess. Every time there's a rate cut anywhere, the banks will always get hit the first. But then when they release their results, if you see in February, if it's still strong, and then everything is going in line. And more importantly, their provisions are in check. I think the shock last quarter was from UOB, where they did that huge provisioning, we call it preemptive provisioning that came a bit of a shock. Yeah, so if provisioning is still stable, we believe that it will still resume quite a stable uptrend. Yeah, and also more importantly, like what I was talking about for almost 5 minutes earlier, the capital returns, it needs to be very clear to everyone, to investors, that how are they going to be returned that massive amount of capital, which is why DBS is performed so well, at least for the whole of this year. I cannot. Yeah, there's one more here asking, OCBC seems to be performing strongly. Would you be revising upwards your TP of $17? Yeah, very good question. Yeah, if we do revise it, we will let you know. Yeah, you'll be the first to know. Don't worry. Yeah, but I cannot give any suggestions of if or when will I be revising it. Will UOB be a buy with its reasonable PB and high dividends? The dividends are actually not very high. I mean, if you look at the dividend yield, yes, it would be high because their share price has taken a hit. PB also is reasonable now because share price has taken a hit. So everything is very relative to their share price, and there's a reason why the share price has actually taken a hit. It's because of quite a poor set of results, right? If you clear the whole thing, even if you remove that preemptive provisioning, which it did, you look at their revenue lines, right? It's the other two banks are showing quite good growth in fee income, which is what we would expect in a low interest rate environment. But with UOB, it was, I think, a decline. It inched down by about 1 or 2%. And that's a bit of a shock because they just completed their acquisitions of all the Citibank assets in ASEAN. And then now we see that their fee income is actually not growing, right? They put it up a lot of reasons. They say that their credit card expense is higher in Thailand, and also there are some prudent customers, right? And then that's the reason why their fee income is weak. Yeah, so I think must look at it as a whole to see whether or not UOB is buy. We are still quite neutral on UOB. Yeah, quite a few bank questions. Another one here. I think last one before I hand it over to the rest of my colleagues. So for the Singapore banks, any potential to have stock capital reduction exercise? 10 to 1, 5 to 1, or to make it more accessible to retail investors instead of lowering the lot to 10 shares proposed by SGX. Yeah, that's really up to the bank, right? It's up to each individual bank whether or not they want to do it. SGX is making it so that on a level playing field, everybody's the same, right? That's the most they can do. They can't force the banks to do this, stock capital reduction. Yeah, so it's really up to the banks. From what I've heard from the bank's management team, it's highly unlikely that they'll be doing this. Yeah, so they could surprise us. I don't think OCBC will do it. But UOB, I think UOB also said they won't do it. Yeah, they were very clear that they won't do it. Only DBS and only yeah, maybe DBS they might actually do it, but we're not very sure. Yeah, this is really something up to their management. Yeah, okay, I think I took up quite a lot of time. Better hand it over to the rest of my colleagues. Thanks.
Yeah, thanks, Glenn. I can take some questions. There's a question: why did the share price of BRC Asia weaken after FY25 announcement, even after dividend payout is maintained as per last year's amount? Yeah, so I think right after right after BRC Asia's results was released, right? There's headline news saying that their net profit dropped 5% year on year, but that's because they didn't strip out any one-offs. So on the headline itself, the net profit may drop five. It seems like it dropped 5%, but that is because last year second half itself, they have a 16 million one-off gain after selling the Pristine Islands, which is one of their associates. So if we strip out this 16 million of one-off gains, their adjusted PATMI actually increased by more than 30%. Yeah, so that's why I feel like it's a matter of investors' reactions to the headline news itself. Yeah. What do I make of Centurion's investments in the Perth PBSA news? Yeah, I think it's positive because I feel like Centurion has a very good track record of entering into Australia's PBSA. Um, this Perth PBSA will be under the premium brand, so they are able to charge a higher rental rates for the students itself. And I feel that they are trying to target the more affluent Chinese students, which we may see an increase in trend after what's happening in the US. More Chinese students may be flowing to Australia and UK as a result. Yeah, but we are still in the early phase because the PBSA will be completed in December 2027. So that's like 2 years later. Yeah. There's a question: what to expect from Oracle, Adobe, and Broadcom results this week? I'll just answer the Broadcom portion and leave the question here. So for Broadcom, I think as mentioned earlier, we do see them exceeding their guidance in this quarter itself because they are designing the application specific chips for Google itself. So because of Google's release of TPU, which is expected to be in this quarter itself, we see Broadcom's result being very strong in this quarter because they also have their networking segment, which Nvidia has been experiencing a very strong demand over the past, in the most recent quarter for their networking products. Because Broadcom has a 70% market share in Ethernet networking products, we do see very strong demand for that segment on their end as well. Yeah. There's a question about EQDP and midcap. Which companies in the midcap do you think will be attractive to enjoy the funding? Would Bal State, Takraw, Centurion, Kimley, Thai Bev fall in that category? Yeah. So I think because Paul is not in this meeting right now, I'll try my best to pick on this question. Last week we actually talked about the Phillip, our EQDP hit list. So basically which companies which we feel will benefit from the EQDP itself. So if you want a more in-depth explanation, you can check out our last week's recording. But in that list itself, we do think Centrum will benefit, as well as BRC Asia, as well as Thomson Medical, as well as HRNet Group. So that's the mid-cap stocks that we think will benefit. Also Penn United and WeHer Holdings because of the strong construction sector in general. Yeah, so hopefully that answers your question. Yeah. Is Micron exiting consumer memory segment for the stock? Yeah, I think so because I think as the company makes a business decision which is to focus more of its resources to supply high bandwidth memory. I think that's a logical decision because I feel that high bandwidth memory will be able to command a much higher margins as compared to the consumer memory segment because PC and smartphone memory chips are still uh quite experiencing quite moderate growth. It's not as high as the high bandwidth chips, memory chips. Yeah, so I feel that it is good for Micron. Yeah. There's a question about LUM Research. With LUM Research strong performance, why is there report of a stagnation of inventory takeout from its supplier UMS? Yeah, there's a second part also, but I'll just try to answer this part first. Just to clarify, we don't cover UMS. We also don't cover LUM Research. So, but I attended the earnings call, and from what management responded to us, uh, they they also mentioned that LUM Research provided them with a very rosy forecast, but the inventory pull in from them is very slow lah. So I do believe it's sort of a timing issue. Uh, because with a very positive prospects from the memory sector, I do believe that LUM Research is able to benefit from it, and also I think they are able to pull in the inventory from UMS going forward. But yeah, so with regards to the second part of your question, will UMS benefit from the expected strong revenue performance from LUM Research in next quarter as well as the whole of FY? Uh, I think it's very hard to say what uh in terms of timing when will they be able to benefit because uh there's also similar question being raised during the earnings call and management just tried to avoid the question. Basically, they mentioned that they will try their best to ask LUM Research to pull in their inventory faster lah. So they also didn't really provide a very clear guidance on in terms of timing when will the pull in of inventory happen for UMS. Yeah. So I feel that overall next year should be a better year for UMS. Yeah. Why is UMS delaying the ex bonus date for its bonus issue exercise that was announced around November 12th? Yeah, thanks for the question. Actually, just to clarify, I think that the announcement did not disclose any ex bonus date. I checked it out and they just mentioned that the record date will be disclosed after they receive approval from SGX itself. And then the most recent announcement in November 12th was to say that they have received this approval from SGX and they will release the details of the record date uh in due course. So they haven't released any dates regarding the record date. So I think we can keep in mind, I mean keep in view for that. Yeah. So question after my presentation on Semicon just now, what impact and conclusion can you say on the local counters like EM, Franken, UMS, and global testing? Yeah, I think overall, for local counters, we may face a slight softness in the next quarter as well as the first half of next year because of a slowdown in capex guidance and also orders from TSMC itself. That's why overall equipment makers have been guiding a slowdown in terms of revenue growth, and I feel that will also flow through to the local counters. Um, However, in terms of the growth itself, I think the second half next year will the growth will also flow through to the local counters lah. For example, for Franken itself, they supply to ASML and Applied Material, and I think that the growth on the second half of next year will also flow through to Franken as because the orders of high-end EUV is expected to come to begin in the second half of next year itself. So because Franken supplies for this particular equipment itself, we think that they will experience an order ramp as a result. Yeah, so for EM, I think they also supply to a memory player. So overall it's still undergoing a bit of a recovery lah, because their main customer Intel is still on a recovery track. So I think next year will be a better year for AEM. For global testing, we don't cover them, so I'm not very sure of their customers and equipment now. But going forward, if I have any information, I'll let you know again. Yeah. What is my view on BRC Asia and Pan United going forward? Why the slight dip? Yeah, I think that the slight dip is because of profit taking. Because over the past few quarters, the stock price has ran up. I think more than 50%. So I feel like there's some profit taking involved. But I think going forward, we see higher ready-mix concrete volume as well. There's an increase in about 10% of ready-mix concrete volume, and I think that will also benefit Pan United for their second half results. Yeah, so we do have to wait until February before we can come out with a report on that. And also for BRC Asia, we are positive because, as mentioned earlier, if we strip out the one-offs, their net profit actually increased by more than 35% year on year. So we are positive on BRC Asia. Can I share my view on NVIDIA collaboration with Intel? What would be the upside downside for both of them versus other big players? Well, I think it's a very loaded question. Okay, so a little bit of background is NVIDIA mentioned they will invest $5 billion to Intel, and in turn, Intel will design CPUs to be built into NVIDIA's GPU racks, and NVIDIA will design GPUs to be built into Intel's commercial PCs. So the upside for NVIDIA is that they will have exposure to the more mainstream PCs, because currently NVIDIA only has exposure to the more high-end gaming segment. Then for Intel, I think the upside for Intel is huge because and NVIDIA's GPU rack is currently ramping for their Blackwell GPU, and next year itself they also have a very strong product cadence of the Vera Rubin GPU coming up. So I think with Intel designing CPUs into NVIDIA's GPU racks, it will be a huge upside for Intel. In terms of downside versus other big players, I think this announcement is mainly about upside for both these companies. There may be some risk involved in terms of to TSMC itself, because TSMC currently mainly manufacture for NVIDIA. So I think there's some reports speculating that TSMC may face risk if Intel Intel broaden their collaboration with NVIDIA to produce chips for NVIDIA, but we still have to. It's still at the early stage. We're still not sure how it will develop. Yeah, I think I'll hand over the time to my other colleagues. Yeah, I'll type the rest of the questions. Thanks.
Okay, now let me answer some first. Yeah, there's one question on the REITs. Why is it selling down despite the high probability of Fed rate cut? Why is this so? Yeah, so first of all, I think the REITs year-to-date performance has been quite stellar. A lot of it has already kind of priced in when it's up almost 10% year-to-date. So that's because I think the probability of the rate cut initially was quite high. So expectations over the past few weeks, there's a bit of volatility whether there'll be a rate cut or not this December. The expectations were becoming of a rate cut becoming lower and lower. So as a result, REITs kind of sold down because of that as well. But now we think it's very likely that there'll be a rate cut. So we think going forward, we think the performance will still outperform. But then again, we are not so fixated on whether there will be a rate cut in December or not. Of course, a rate cut will definitely help, but we need to know that the rate cuts is a general trend that is what's important. Like we believe the interest rates over the course of this year and next year will start coming down. So that will continue to benefit the REITs with lower interest expense. So it's the trend and not so much whether they'll cut in December or not. That's our view. And we also think that the market is kind of under appreciating the fact that the Singapore SORA has really fallen to about 1.2%. So that is like 200 over basis points decline year on year. So that is the one that will really benefit the Singapore REITs. And it's not so much the Fed. I mean, of course, the Fed rate cut will help. There will be a bit of flow through to a SORA, but generally, if Singapore loans, the base rate is SORA. So that's the one that we need to keep a lookout for most of the Singapore REITs. For like the US listed REITs or those with US loans, of course, the Fed fund rate or the SOFR will be the one to look out for. And that's the one that be impacted by the Fed rate cut. Yeah, so all in all, we still believe the downward movement or downward trend in interest rates that will be the true beneficiary for all the REITs, rather than just a specific month-on-month rate cut. I mean, it will help, but yeah, I think it's the general trend. Yeah, which is a better choice, Manulife or Prime? Yeah, so I went over the Manulife presentation. So that is basically them trying to exit from the MRA, where they have to sell assets to lower their gearing to below 50%. So Manulife definitely are still facing some challenges. While Prime, on the other hand, their assets are better located. They've signed good leases, positive rent reversion, occupancy remains high and continues to improve. We expect at least 85% by this year. And there's also income visibilities for Prime US REIT, especially since a lot of their leases have already been signed and the cash contribution will start coming in, gradually from now until next year. So definitely we prefer Prime. And Prime, given the fact that they have a strong income visibility and they've set aside enough capital requirements for kickbacks that they've committed to pay at least 50% distribution payout in 2020 for second half of 2025, which will get a payment in first half 2026. Yeah, so definitely we prefer Prime. CDL sold Osaka Hotel recently. Any potential of higher dividend being clawed back in to investors? Yeah, we think there is a very high chance that FY 2025 year end we'll see some special dividends from all the divestments that they did. The big one was the Southgate divestment. So yeah, we do believe there is a very high potential that they'll pay out some special dividends for this end of this year's results. Yeah, so keep a lookout for that. Yeah, I think the market is also pricing that in a little bit. The share price has really performed well for CDL. Yeah, they're also doing a lot of other divestments and recently they also acquired a hotel. Yeah, so they're really recycling their capital effectively. Yeah, any reason why capital series weakening amid all the publicity and high raw data centers booming in short supply? Yeah, so the data center thing that we noted is that the specs of the data centers is quite important, like whether they can support AI or whether they are water cooling or air cooling and the electricity requirements and such. So and also of course demand and supply. So for Keppel DC, their assets are in my view are the out of the three listed REITs, US data center REITs, Digital Core and pure entity DC REIT, the pure play data center REITs. The Keppel DC REITs, their assets are definitely better. They're Singapore centric, and yeah, they are the ones that can really generate the very high positive rent reversion going forward. And Singapore is a market that's still the one that really drives this growth in rents for them. Yeah, and but you just see why I think why I think Keppel DC REIT per se is weakening. I think it's because of partly because of a lot of the additional shares that they raised. Yeah, so as a result, like they did a recent preferential offering also, and they also did a private placement last year. So there are a lot of new shares in the market. So I think there's a little bit of investors taking profit as well, and not to mention the fact that at the price of about 2.30 capital DC, they're trading at about 4%, 4.5% yield. So yeah, the market is really pricing in the fact that their assets are much better than the other two listed REITs. Yeah, so I think that's roughly my view. Yeah, hand over to Tammy. Yeah, before handing over to Zena, thank you.
Hi, thank you, Darren. So, there's two questions on Salesforce. So the first is, your target price for Salesforce is a lot higher than its current price. So what is the current market consensus, the target price? So the current market consensus for Salesforce is $326 US, while the current Salesforce price is 260. So the average price is higher than the current price, and the higher end of the market consensus is the $415 US. So we can, you can conclude that most of the analysts are quite bullish on Salesforce. So even if you're buying at ours is a bit higher than the current average price, target price, but if you buy at the current and expecting the average target price, and that's about 25% of the upside that you could get. And then we do think that ours is slightly higher because our group rate is slightly higher than the rest. So when every quarter they keep raising their guidance, right, like they did, so that significantly push up our target price. So maybe I will check later on the group rate later. But we still remain bullish on the Salesforce even if we downgrade our group rate. Yep. And then the next question is, what does Salesforce professional services cover? What is the possibility of further revenue increase in this area? The Salesforce professional services is the outside of their core services. This is the products that is still, for example, on-premises platform. While many of the products has already transferred to cloud services, so many of these products is still on-premise, I mean in the enterprises area. So it's not really when it is reduced, it's more like most of these customers are shifting to cloud services instead of not taking it altogether. Like some of them are still using them, but just that they are shifting to cloud services. So you see some of these this small category, which is only 5% of the group revenue, is shrinking like 5% year over year, but actually more like customer shifting to cloud. But then again, so we think there's a possibility for the revenue to further decrease, like they did 5% year over year. But then again, would it impact the group revenue overall? We don't think so, because this professional services is only 5% of the group revenue. So only 5%, and then it's declining at 5% only. So the size is small. We think that it's only about 0.3% that would drag the group revenue growth rate year over year. So it's not big enough to drag the whole group revenue. So next question is that what to expect from Oracle, Adobe, and Broadcom. So moving on to the maybe on Adobe first. Sorry, on Oracle first. So for Oracle, what can we look forward to? There's so many things on Oracle, right? So first thing first is on their debt issue that they are quite. First is that they're quite aggressive on the capital investments. Like last quarter, they raised up their capital expenditure target quite aggressively. So that was quite a concern. And then not to mention for the last this current quarter, there's also news that said out that they already increased the debt amount. So it's about more than double, I guess. They increased the debt load. So this increase in debt raised quite an issue when they raised about, in total, 56 billion in borrowing. This includes 18 billion in bank loan. Also, the rest come from bond that they raised. So it's about more than 80 billion US dollars. So this, what market said that debt to equity ratio is approximately 520%. This is quite concerning. Like most of the other hyperscalers never did something like this. So this is quite concerning. And this in return provide negative cash flow for Oracle for the first time in 23 years. So that's an issue first that we could look forward. I think the management would probably address this. don't think that they would be. I don't think that they would address many of the issues, but I think this is quite important. They would address this. So let's look forward in the next report that in this week's that I'll release, and then the share price plunged about 30%. Some of them is also because of the market sentiment, I guess. But the debt issue is real. But then again, there's also because when they raise the debt, this CDS price, which is the cost of protecting against Oracle's default again, that debt has surged quite high, like too high. So that in return, when this CDS price surge, meaning that people are looking forward for the Oracle's to default on their debt, right? So in return, share price goes the other way around. It plunged that. So is the investor confident? It goes the other way when the CDS price goes up. But then again, some of these positive points that you could still keep holding while these negative points are there. Some of them is that the Oracle do have enough cash, including the convertible cash, about $11 billion to cover the $5 billion of bond that would mature in 1 year. This includes the interest rate. But then again, people are looking forward to more than 1 year, not only 1 year, but at least for the near term, that default probably wouldn't be there. And then there's also future EBITDA potential, meaning like with the increase in backlog, the order book, increase in capital expenditure, there's also would probably be increase in EBITDA. I mean, increase in earnings that they could make from this. Because last year, when they increased their capital expenditure, they doubled, right? In 24, I guess, financial 24, their earnings also jumped quite high. So when they also the same pattern, wouldn't say it would really happen, but when they increase their capital expenditure like that, like they did previously, the same pattern, then we would probably looking forward to increase in jump in EBITDA as well. So that's about Oracle. Then for Adobe, well, the issue is, same issue. So first is on the, where recently they acquired Semrush. So probably they would talk about that, how it would contribute to the business and how it would affect the guidance. So there's probably increase in the guidance as well in the next quarter. And then there's also the same issue on competition, because many of the AI products out there, for example, Sora, can now compete with the Adobe, video generation and photo generation like that. So it looks to us in the market that the Adobe's modes, which is what they're especially where they're one of the specialized in video generation and all of that, would like being threatened by this new AI application out there. But then again, the view for me at least seem for small enterprises, maybe people would switch toward this smaller client. They would switch from Photoshop and all that to this AI for basic functions. But then again, Adobe is not only photo generative and not only video generative. For this reason, for large enterprise where they have many users and a bit of complicated at that, right? You can't really not using Adobe altogether just because now you have Adobe, now you have photo and video generation that out there that could compete with Adobe. Well, for large enterprises, this would be a catalyst of them instead of them just not using Adobe altogether. Yeah. So for Adobe, we're looking forward to that competition and also AI adoption. Last time, their Firefly, which is their AI application, the adoption rate is about 30 to 40% year over year on quarterly basis. So that's positive. Not as high as Salesforce when it comes to double, but this is been and the AI revenue, maybe that's a bit of what market is not looking positive to it because their AI revenue is 1% of their total revenue at now at current rate. Their AI annualized recurring revenue is only 1% of the total revenue. So that's still small. But then again, when they start to announce AI revenue about 3 quarters ago, it has grown considerably well. So, and it has reached the year-end target last quarter or the third quarter instead of full year target. So that's positive as well. So that is the update that we are looking forward to Adobe and Oracle. Right. I will update the report coming up next week. Yep. I think that's all from me. Pass over to the next presenter if they to answer some question.
Thanks. For me, I'll go through some of the technical questions now. I'll just share my screen. Okay, so I think first up, there's a question on C Limited. Yeah, so in terms of the chart, I think C is still showing currently downtrend momentum. I think the key resistance is at the 20-day MA, which is current this yellow line around 140 about there for now. So I think overall we might still see a bit of a downwards momentum. But I think a good support will be somewhere close to 120 level, which was previously this a key horizontal resistance and support area previously. And then also in terms of Fibonacci retracement levels, is around close to the 50% level. If you use the $34 swing low and the swing high close to about $199. Yeah. So I think downtrend might still continue on for now, but I think we'll be able to find support closer to 120. And currently, in terms of the momentum indicators, MEC is quite flat, and RSI also quite flat as well. So we might see a bit of slightly down or sideways movement for now. Then next one, okay, with 50D. Okay, sorry, I'm unable to find the counter for this. Maybe we can retype the stock code. Yeah. I'll go through the rest first. Q&M Dental. Yeah, so for Q&M Dental, I think I think it might most probably it will continue the uptrend for now. So because in terms of the price action, I think managed to break out this short-term downwards resistance line, and then another confirmation is that we recover above this 50.5 cents level over here recently as well. So I think overall I'm expecting price to continue uptrend similar to the previous up waves over here. Yeah, so I think next key resistance will be the swing high at 55 cents, and then hopefully you can retest this channel resistance again somewhere close to 58 cents as the next resistance for Q&M. Then next one, next question is 878. Hong Kong Land. Yeah, so for Hong Kong Land, I think currently price is a bit slowly inching upwards. So price made a recovery recently by holding above this $6.35 level, which was previously a breakdown level. Then currently in terms of the short-term price action is also holding above this 650 resistance level turn support in the start of this month. So I think that's quite positive. And I think we should be able to see price slowly continue some upside towards about 676 to about 695, 690 in the midterm as the next resistance level. Okay, thanks for clarifying. I think the counter is 5DD micro mechanics. Yeah, so in terms of micro mechanics, I think currently it's showing some weakness since there's a lower highs and then breakdown of this 170 support level, which has tested multiple times, and then yeah, so overall in terms of the bigger picture wise, I think micro mechanics we could be able to see some maybe some support close to about 160, which is this about this longer term uptrend channel support level, as well as some previous resistance levels previously around here in May to July this year. And so I think overall we might see some bounce over here and some sideways afterwards with some resistance at 166. Yeah. And next one is on the 3 local banks. Yeah, first one for DBS, I think generally, I think nothing much for now. In terms of the price action, we're seeing very small body candles over here, which suggests, I think it's just range consolidation and there's not much trend going on right now. So I think for now, it's most probably just some sideways consolidation, some support for now is like around 54, and then below that is around 50, around like $53.40. Then resistance is the recent highs around like 54, 50 to 54.80 about that. So I think DBS for now, nothing much expected. I think it will be just quite sideways. And for UOB, it's looking a bit better in terms of the price action. In December, I think price managed to break above this 34, 38 resistance level over here and just moving sideways for now. So I think most probably if we could see some better price action than just moving sideways with some the next key resistance probably around $35, which was the resistance end of October. Then for OCBC remains the strongest among the banks for now. Recently managed to make a new high, but I think for now there could be some slight pullback from this recent high because there's some bearish divergence in terms of the indicators. And I think could be able to find some support somewhere closer to about $18.50 to $18.60 over here, which is a 10 and 20 days moving average. Then maybe you could just do a bit of a sideways afterwards. Yeah. So that's for the banks. Then next one this question is on Sembcorp industry. So I think for Sembcorp industry, overall price action has been still quite weak today. Today, continuation of the weakness after the breakdown of this 620 level, and then today we're seeing a breakdown of this 596 level as well. So overall has been not very good. I think I'm expecting some further downside overall towards next key level will be around 556. This previous level bottom previously in March to April this year. In terms of the weekly charts, also quite weak for now, below the 5 and 10 day moving averages. And next one is on Singtel. Okay, so for Singtel, I think currently there's a bit of a pullback in terms of the price action. So the price is below this 470 level, and then some also currently below the short-term moving averages as well. So I expect some pullback for now. I think the next key support for now will be somewhere the 10 MA on the weekly. Perhaps somewhere closer to about 447 to 450 about there. Yeah. So we could see some slight pullback consolidation for now. Then I think the 50 MA daily, this green line is also quite around a good support level recently during this uptrend overall this year. So we maybe can take reference from there as a next support level which is currently around like 440. For Singtel, expecting some slight pullback. But overall, the long-term uptrend is still intact now. Next one is the CFA index ETF, which is this this ETF. So for this CFA ETF, I think overall for now, most likely some sideways trading towards slightly towards downside because price was still facing resistance at 84 cents, which previously this breakout level that wasn't able to hold. And then most likely will test this 81 to 82 cents support level again over here for now. Yeah. So overall, we might see previously this uptrend and then now moving more towards a sideways range since October this year. The next one is Comfort Delgro. So for Comfort Delgro, I think still nothing much, still not much strength, but I would think also should be able to just find support at this 140 level, 144 over here. There's some supports and as well as an uptrend channel as well. So I would think overall should be quite sideways for now with still be a lower highs. Maybe some resistance for now is at 147. Okay, then next one is on SIA. So SIA also still also some weakness as well. Where 640 is a support now holding as resistance, and next key support is around 630. So most probably sideways price action for now, 630 to 640. Yeah, then below that I think the next key support will be somewhere close to 620, where this is this blue upward support line overall as well. Yeah, so I'm expecting quite sideways to slightly downwards price action for SIE now. Next one, some US counters, Grab and Oracle. So for Grab, I think for now it's still a bit weak since since it break down below this 550 level, previously there was a strong resistance. November last year to September this year, breakout. Price did sideways, but overall afterwards lower highs, and then was a breakdown, and currently it's trading between like 484 to this 550 level. So I'm expecting quite sideways price action over here right now. Then for Oracle, I think overall still in a bit of a downtrend, but I think there might be some rebound coming soon, I feel. Because in terms of the current price action, has been a bit more sideways recently, and then starting to recover back over some of the short-term movement ranges. For example, previously during the downtrend, this red line, the 10 MA was a resistance, and currently is trying to hold back above there. And also you can hold this 210 level, which was this horizontal breakdown level, that will be better as well. So I think you can price and hold this level. We might see some short-term rebound towards some of the near-term levels like 230 as well as 247 about it for Oracle. Then okay, I'll go through one more since it's about 1 o'clock. CATL. Yeah, for CATL, currently I think most likely quite sideways. Yeah, for most likely quite sideways price action, because price found support after retesting this previous 467 resistance, and then currently it's just moving trying to rebound back slightly. So in terms of the weekly, I think the key reason will be probably around 520, which was a horizontal breakdown level as well as a 10 MA over here. So we might see some rebound, but 520 I think will be quite a key resistance for now. Yeah. Okay, I think there's just a question on the graph. What's the resistance and support price? Yeah. So for now, I would think resistance probably around 540 to 550 this area. And then for support, I would think it's around 485, the recent swing low. Yeah. So I think I'll stop here for today. I think there's still quite a lot of questions in terms of the TA. Sorry, I'm unable to cover all of them due to the time constraints. But appreciate for all your questions, and on behalf of my team, I'd like to just thank everyone for all your questions and joining in our webinar today. Yeah, and for this week, we have a few corporate insight webinars such as WeHer and Marco Polo that's happening middle of this week. So do feel free to tune in and ask questions if you're interested in the companies, and hope to see you again in our final webinar for this year, next Monday. Yeah, so thanks everyone, and hope you have a good week ahead. Yeah, I'll just end here for today. Thanks.